Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I am Ryan Nauman, the market strategist here at Zephyr. 2025 was a great year for global financial markets as AI continued to be a hot theme and helped drive markets higher. However, lofty valuations and high market concentration might cause some to be more cautious moving forward. Well, I am lucky to have two industry experts who are going to address the potential risks. And is it time to rethink your view on investment risk? But first, today's episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, let's move on to the stars of the show. Enough from me. I would like to give a very warm welcome to Vickie Lewin and David Hatfield. Vickie is the Chief Growth Officer and David is the Chief Technology Officer at Amplify. Vickie and David, thank you so much for coming on the show. It's an honor to have you on. Really excited about this conversation. Can you please tell us a little bit more about yourself and Amplify?
Sure. Why don't
We'll start with you, Vickie.
yeah,
Yes.
why don't I go first? So Amplify is a growth platform for RIAs. We provide most of the core functionality that an RIA would need, everything from client lifecycle management, research, portfolio construction, model marketplace, rebalancing, trading, performance reporting, billing, client portal. So we are a growth platform for RIAs. We think of ourselves as a growth platform because the way that we are built is designed to be touchless, meaning it needs fewer humans to get the job done, and all of that human capacity can be freed up to do more business development activities. I'm the growth officer at Amplify, which probably tells you exactly what my role is, which is growth on the platform, but not just about getting new RIAs to look at and engage with our technology, but also importantly, making sure that existing clients are leveraging the platform and using it to grow, not just organically, but through advisor acquisition. I will tell you that the brains of the podcast today is my colleague David Hatfield. I'll just say a little bit about him and then pass it to him. He's shy about bragging, but David is our Chief Technology Officer. He's been around since the beginning of Amplify. He wrote the first line of code back in 2018, and so Amplify, as you might imagine, feels a little bit like his second child.
Very much so.
I love it. Thank you,
Yeah.
Vickie.
Thanks,
David.
Vickie. Thanks, Ryan. Absolutely. So, Chief Technology Officer of Amplify. And, one of the things that we really wanted to do with Amplify was create a system that was easy to use, that did all the functions that the highly demanding advisors wanted. And, we had the ability to build it and test it against advisors on a day-to-day basis. And that's what we continue to do. So, the core tenets, like Vickie went through a whole list of, technology pieces that we offer. But the core tenet of what we're trying to do is make these tools approachable, make them easy to use, make them tools that advisors want to use because they enjoy using them. They're effective every day in enhancing their workflow, enhancing, the servicing of their clients.
David and Vickie, thank you. I love it, David, that you were the one that wrote the first line of code. I think that's fantastic. I love it. Thank you for coming on. And, at Zephyr, we are investment analytics software. So, unfortunately, gosh, it was started some 30 years ago. So, the first person that wrote code is no longer with Zephyr. But I always love talking to those people. And it's like, it's such, great thought process there. And just starting out a great software, a great application, a lot of fun. Vickie, 2025 was a great year for global financial markets. A lot of analysts believe 2026 is going to be a positive year, a lot of momentum heading into the year. But there's some risks out there. The boogeyman is lurking, as some may say. Do you agree, or do you think it's time to be maybe a little bit more cautious as we move forward?
Yeah, Ryan, personally, every time I've decided to be more cautious, I was wrong. So I've long learned not to necessarily trust my instincts there and let the pros do that. 2025 was a great year. 2024 was a great year. 2023 was a great year. And if you'll remember in 2023, everybody gave us all kind of reasons why we should be more conservative. And I know lots of people have a lot of regret if that's the decision that they made. Risk, I think most people think of risk as the risk of losing money. But I think there's also risk of not being invested aggressively enough to be able to achieve your objectives. And I think people need to think about both. The risk people are talking about now is maybe the pain of regret for what they didn't have, but all over the papers right now, yes, just exactly what you said. Most of, if not all, I think in the last article I read of the market strategists are saying that 2026 is going to be a good year. They're saying good, not great, right? It's funny, you hear 5 and 6%, and that doesn't feel very exciting when you're coming off of what we came across last year, but I'll take it. I'll take that over a down 20. And then Ryan, you and David and I have all been doing this long enough to know that it's not if we have a down market, it's when. And then for financial advisors and investment managers is what did you do to manage your clients' risk? What did you do to manage their expectations? What did you do to talk to them in such a way that when that moment happens, their portfolio performs in a way that they expect and understand, and that you've communicated to them that this is one of the costs, if you will, of being invested in markets that can perform really well. So, at Amplify, we do have a really great tool. David is the co-author of that tool. It's called Quantum Risk, where we do exactly what I've just described. It's a tool where we help advisors have better conversations with their investors and prospects about risk. We think that we've done it in a smarter way with better math, meaning factoring in fat tail risk. And we do, and I'll stop monopolizing the answer here. And we do think now is a really, really, really good time to go back to your clients and talk about risk, because even though 2026 could be just fine, it could not be just fine as well.
Vickie, that is spot on. And David, a perfect segue to David. But Vickie, real quickly, I'm really glad you brought it up. You are exactly right. When I talk about risk and investment risk, it's evolved over the years. When I started aging myself 20 some years ago, it was all about volatility, standard deviation, and but now it's like, give me all the upside deviation you want,
Exactly.
right? Like, bring it. It's a downside deviation. It's like losing money. That's when I talk is and do research. It's all about, losing money. That's a true risk. But I love that you brought up there's a risk of not being invested. Markets have been very resilient. Look back at COVID. Everyone thought that we were going to go into a recession. Markets ended the year positive in 2020, right? It just proves that it's resilient. Should investors be concerned about valuations right now, though, too? The Shiller Cape ratio is around 40, which is very high. Should they be concerned about valuations, you think? Or is it just let the party continue?
Yeah, or Ryan, in your chair at Zephyr, you've been doing this long enough to know is the answer to that question is it depends, right? It depends. It depends upon the investor. It depends upon their time horizon. It depends upon what the money is used for. And so, the short answer to that question is yeah, if you need to spend the money in the next 2 years. But the answer might be maybe not if this is a 10-year investment and the risk of being out is just as big for you, as the risk of being in. And that's exactly why Amplify and David co-authored the kind of tool that we built so that people could get really comfortable with understanding that they have the right amount of risk for what they need, but also the right amount of risk for what they don't want.
Fantastic. David, Vickie's set it up perfect, teed it up for you. Perfect. Let's talk about that risk and having that conversation with clients for a financial advisor. When markets are roaring, like Vickie said, over the past 3 years, it's really easy to forget about risk, the risk of investing. It's like markets just keep going up. Why do we need to have to worry about risk? But as Vickie said, eventually it's going to happen. All good things have to come to an end. How do you view investment risk?
Yeah, that's a really good question. And you had a keyword in there that I want to focus on is you forget about it. A lot of times, you go through the process of making a proposal. Here's the perfect portfolio for you, client. You've matched them with their suitability, some sort of questionnaire that got to, some output of how they feel about, their investments. Their propensity to lose typically is a big part of that. They go through the proposal process. Okay, cool. It lines up, checks all the boxes from a compliance perspective. They say, okay, that document kind of gets put in a drawer and then they don't really look at it again. Right. So the forgetful portion of it, I think, is one of the big things that, we need to solve for. Because if your tool for doing risk is kind of sitting off to the side and you never go and visit again, then that's probably the worst risk tool that you have in your arsenal, right? Because you're not using it. So one of the ways that we're addressing that in Amplify is we make risk and all of the way that we calculate risk permeate across the platform. So it's having that conversation and having those pieces available to the advisor in their everyday workflow is important. So whether you're looking at an individual security, you can see risk on that. Whether you're looking at a model portfolio that you've designed, what's the risk on that? When you're looking at a particular client account or the collection of accounts in a household, what's the risk on that? It is right next to all of the functions that they're doing from a day-to-day basis of, do I want to check what the year to date is? Oh, side by side, here's how it's currently positioned from a risk perspective. And so having that right there keeps it top of mind for anybody looking at it. And so that conversation, when you see, hey, maybe this risk number has drifted away from our tolerance number, it is time to have a conversation. Or the client calls in and says, how's my account doing? Okay, you can say you're up this much year to date, but also, here's your risk profile. Fostering that client conversation from a day-to-day basis or from a week to week, not just on an annual basis or whenever you get to it, I think is important, because if that check-in point is there and you can make the client feel better about their risk positioning, then the advisor's doing their job.
You know,
David, that's or yeah, go
Yeah,
ahead, Dave.
Ryan, David, I love that you reminded everybody that the conversation is probably the most important part of that. I read an article this morning. I think I'll have to credit Michael Kitces for it, but the article was, you don't need another tool. You don't need better math. You need to be having the conversation. I would argue all three are helpful, but the conversation's the most important part.
Yeah. Having the tools makes that conversation easier, maybe, right? Or it helps you support that conversation. So I always try to have some data.
Yep.
Otherwise, they're like, Ryan, what are you talking about? They may not believe me. But David, you made a fantastic point about just, we talk about risk management all the time, but sometimes I think it gets pushed to the back burner. So I love that you guys are, always keeping it at the forefront, because managing risk is so important, especially now, even though people want to forget about it, it's very important. So when you think of risk, a lot of people, like I said, years ago, it was all volatility, standard deviation. Then we got the MPT statistics, the Sharp ratios, Sortino ratios. And here at Zephyr, we've taken it a step further to really focus on drawdown statistics with the pain index, pain ratio. Is it time to look beyond the traditional MPT statistics?
MPT has been great. When it came out, it was awesome because there wasn't really anything else, right? So as you continue to advance, the statistics have added to the overall conversation. I think part of the reason why they've been so pervasive is the relative technology compute power is fairly low for those types of statistics. And so it was not overly complex to implement, call it inexpensive to implement, right? Um, but those were probably also a product of the computing environment was different than it is now. So we have oodles and oodles of compute power. We have GPUs, all these things to make these computations easier, where now it's more accessible to get to something like tail risk. Now, tail risk is a little bit different than your standard computation that you're looking for, that you've been looking at for the last 20 plus years. MPT is really good at kind of smoothing out and saying, what's kind of my average loss, if you're looking at loss, right? Or what's my average kind of behavior? Tail risk takes a little bit different approach where it says, okay, when things get bad, how bad do they get? So you're effectively putting in a better floor to, how bad it can get. And so where standard deviation can kind of hide from a month to month basis, those really bad months, because then, maybe there are a lot of really not so bad months. It works itself out to where, you kind of miss some of those details. Tail risk just highlights, here's how bad it can get. So if your ultimate pain point is that drawdown, tail risk is going to tell you, it's going to show you that. And so it's certainly a more complex statistically piece of math to implement, but solving that, then we just have to put it in a package that's easy for the advisor to explain that to their client. And you touched on that as well, right? If the client says, what are you talking about? Then we're also not doing our job. So packaging then that tail risk, what that number means, into something that's, conversationally feasible for the advisor, because they don't want to have to learn massive amounts of statistics to train their clients on how to accept this, because that's just going to make the conversation fall flat. But once we can do that, which quantum risk we believe we have, then that conversation gets easier. Plus you have, the added benefit of, you're really looking at how bad can this get, and your risk number has a better chance of not freaking out your clients when they do start to experience some of that pain.
Vickie, do you have anything to
Yeah,
add?
well, what we did, Ryan, I'll just, I'll get to kind of the punchline is what we did is we have all the really powerful math behind tail risk, which is what you get, from the Aladdin tool that BlackRock uses and some of the tools of some of the big institutional powerhouses, right? So you get the math behind it, but David and his co-author made it really simple by simply pegging the score of 100 to the S&P 500. Right? Advisors understand that, investors understand that because they're used to seeing like beta 1, right? So they pegged it to, right? They pegged the S&P 500 to 100. Now, what to be true today is there's a lot of investments that are riskier than the S&P 500. You've got levered products, you've got single security, right? You want to put 100% in Nvidia. Sure, that would have been great, 5 years ago, but will it continue to be great 5 years from now? So they pegged it to 100. And what's powerful about it is then an advisor and an investor, a prospect, a current client can really quickly see, am I going to get better performance? And I'll use the word we all know, and more volatility, more downside, risk if I go to a higher number. Yeah. And maybe they want that. Maybe they want more juice in the portfolio. Some people want a little higher octane in portfolios that they're holding for a longer time. And then as things are more conservative, they'll see that reflected. So you're getting the complex, more advanced, better math in a really easy to use, easy to understand, I think, tool.
Yeah, Vickie, that's fantastic, because I am a firm believer of KISS. Keep it simple, stupid. And with like David, we could like tail risk. I think that return distribution is a fantastic tool. But I think 90% of financial advisors out there, when we start talking about omega and kurtosis and all those other real, what could be complex statistics out there, VAR is another good one. Eyes gloss over. And are they really going to talk about those statistics to their clients? Probably not. Right. So the fact that you're wrapping all that up in the terrorist statistics, which can be complex, into one score, like I said, keeping it simple it can be very important.
Yep.
Yet
And
very, very
Ryan, is exactly what you said you're doing at Zephyr, is you're looking at max drawdown. So, people might not understand those statistics, but ask them if they remember the financial crisis. Yep, they do. Ask them if they remember COVID. Yes, they do. Those that are, old enough, I think those of us in the little squares here are, how did you feel in the the dot com bust? And they remember. And that's why the financial, press can say, hey, are valuations stretched? Is this another dot-com bust? And people start to get a little nervous because that's what they remember. And if you can peg it to that, I think you can get people to understand, like, look, if we have another environment like that, and I hope we don't, but we probably will. If we have another environment like that, how is this portfolio that I built for you going to behave? And are you okay with that? or are you not okay with that? Because what most investors are not okay with is that classic modern portfolio theory standard deviation, where sure, 88% of the time 90% of the time it holds up, but what about that other 10% of the time when you blow right past the risk that I told you I didn't want to take?
Yep. You're exactly right. And that's why people like Zephyr and even Dr. Bill Sharp, who created the Sharp ratio, came out and said, there's issues with standard deviation, right? And that's his main risk metric within the Sharp ratio. So you have Sortino ratio, things that address the issues, but also, like you said, Vickie, that make it easy, right? And that's like what quantum risk, you said, it's pegged to the S&P 500 score of 100. So let's go, David. What does a quantum risk score measure?
Yeah. So I guess I want to talk a little bit first about that 100. Yep. The standpoint that I think is important is the client's an emotional person, right? When they're considering their money. And so rather than some other scores that may just give you a call it an absolute risk, I got a 90. I don't really know what that means. I know it's higher than what they tell me that the market is. I don't know how much higher. And if it's pegged at some other or it's capped at some other 100, well, am I, you know, 10% away from the maximum I could ever take? What does it really mean? So rather than having this absolute risk conversation where you may not fully understand, most investors, at least the ones that have experienced, a few different market downturns, understand how the market has behaved and they have that emotional feeling of what that is. And so when you see your score in, say, in quantum risk, if you have an 80 next to that 100, it's literally 20% less risky when you compare its tail risk comparisons, right? And so it's a much more emotionally easy thing to solve there. And so, you know, quantum risk is measuring exactly that. It's based around tail risk, but the other things that it continues to measure is what is my point in time. And so if you're making changes to the portfolio, it'll start tracking that and it'll gather that history over time and it'll look back and say like, hey, this account has been, anywhere from a 50 to 120. uh, Might have a question on why, because did you have a bunch of cash that you're carrying and then did you go maybe over? That's probably an extreme example, but we're tracking that history on everything that we're measuring, and so you can understand whether this is a strategic asset, this is a maybe a more conservative or just a tactical fund, right, that can change and move around. It's able to show you so you have a better understanding of that asset, of that account, of that household's portfolio, of where it's been in the spectrum of its historical range of history. And so that's good for a conversation with the client. It's good to help the ultimate compliance question that they may have, and have you been tracking to the client's suitability. But that living and breathing historical building of the history of the score helps drive those conversations, helps give quick insight, because we just give that right away to the advisor and then ultimately to the client if they want to consume it. And then it's just a lot of information, very transparent, but distilled down to just a few data points that help you really uncover what is going on in your portfolio and can make decisions from that.
Yeah.
Yeah, fantastic. Vickie, how should financial advisors use it?
Yeah. So as David was talking, I was reminded of a financial advisor that I worked with at my last firm. And he used to hold what he called lifeboat drills with his clients about every 18 months. And the lifeboat drill was where he would talk to them about, okay, the market goes down 20%. This is the way that you're invested. This is about how your portfolio is going to perform. What are you going to do? And he gets the clients to say, I'm not going to do anything. I understand how I'm invested. I understand that my investments are going to perform over time, not all the time. And he would do that with them on a regular basis. So I think that tools like this can be used to hold. I'll borrow from this advisor that I thought did a really good job. That can, you can hold lifeboat drills with your current clients. I think that tools like this, Ryan, are really great to be used to bring in new clients. There are many, many people that are managing portfolios on their own that think that they know what they're doing, and they probably don't. They have more tools and guidance at their at their disposal than they've ever had, but they probably don't really understand, what could go wrong. And for most couples, if one member of the couple is managing that portfolio and things are going well, it's probably fine. But that conversation and the relationship between that couple might be a little different if, you lose 30% of your portfolio and that's not what's expected. So, the answer to the question is, the Dalbar study, right? The cycle of emotion with investors. It causes people to want to, get greedy when markets are hot, and they get fearful when markets are not, and they end up buying high and selling low, which is exactly the wrong formula for success. So I think the tool should be used to bring in new clients, help them have the right portfolio for their temperament and their goal, help hold lifeboat drills so they understand what to expect when we do have a market correction, expected or not. Sometimes we see it coming, and sometimes we don't. So that at the end of the day, people don't fall victim to that Dalbar study where you get out at exactly the wrong time.
Yeah. David, do you have anything to add about how, maybe how financial advisors can use quantum risk?
It's kind of what we've been talking about, that we want the tool to be used in their workflow. We want it to be where they live, right? So if they have to take an extra step to go get to that risk conversation, then, we're not doing our job from technology, from advisor, fiduciary. We want all that to be part of the overall conversation. And so as long as it's one of those key pieces that's always on their mind, which again, we've made it so not in your face, but it's always present in everywhere that you visit across our platform, that you can't help but not think about it. So it's always there reminding you, hey, if I'm going to make this trade, here's my risk score before I've made the trade. It'll estimate what the risk score is going to be after that trade. So it's always there in every decision, or every even just query that you're doing across the ecosystem here, just to make it top of mind against all the other things that are, part of the decision making process. And I think as long as they're integrating it and they're having those conversations, or at least thinking about it, then they're using the risk score, quantum risk, in the way that is intended.
Okay. Yeah, I think that's important. Like we said at the kind of wrapping it all up here, like you said at the beginning, is we often forget about risk when markets are up, like Vickie said, 20% over the past few years. It's like, why do I need to be concerned about risk? Why do I want to, maybe have a little drag on my portfolio to protect against the downside when markets keep going up higher? And like you said, Vickie and David, is like, now's the time to have that conversation. Like you said, we should always be having a conversation. But one last point here: why is the quantum risk score important? Why do you believe it? I think, David, you've said a lot about, just being on top of your risk, right? Having it front and center so you don't forget about. Why is it important, David?
I think it's important for a lot of those reasons. The fact that we're using what we think is a leading calculation methodology of tail risk, I think, is super important. It'll let the client know, it'll let the advisor know that they're really looking at the portfolio in a way that they can be comfortable with the risk that they're currently taking on, or, they need to take some action. Again, it's integrated with everything that they're doing. We're gathering history every day, recalculating every portfolio every day. So we got that track record that anybody can go back and look at and really just quickly understand how, even if it's a behavior change, right? If it's a investment drift, behavior change, whatever that might be, even, this security starts suddenly moving around differently than it used to, before. All those things are taken to an account, and they're made consumable in a very quick fashion on the platform in a way that I don't know that anybody else is doing today.
Yeah, I'll just
Vic-
I'll just add to it or emphasize it, right? It's a way to make sure the advisor and his or her client are fully informed and they know what to expect. so that when they need to put their life jacket on, they know how to put it on, and they know where the lifeboat is.
Love it. Can I use that lifeboat
You can.
It's not trademarked or anything.
No,
I think that's fantastic.
You probably should have, because it's a good one.
That is good. That is wow, Vickie and David. Really fun conversation. Thank you so much for coming on the show. I learned a lot. I really enjoy don't very often get into analytics of investing and risk metrics. I enjoy it. Some people may think that's weird, but great conversation. Thank you so much for coming on. It was an honor. Vickie, where can our audience get more information about Amplify?
So thank you for that, Ryan. Amplifyplatform.com. And you can find both David and myself on LinkedIn as well.
Fantastic. Thank you so much, Vickie and David. And thank you so much for all of our listeners for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to like and subscribe to those channels and give us a follow on LinkedIn. Thank you and have a great rest of your week.
Thank you.
Thank you.